Hello, everyone. Welcome back to another episode of the Market Chat. My name is Richard Moglen, and joining me today as my guest is Kathy Donnelly, co-author of the Lifecycle Trade, How to Win at Trading IPOs and Super Growth Stocks. And we all know 2020 has been the year for these type of opportunities, and Kathy and the rest of the Lifecycle Trade team have done extensive studies on how to identify and manage these types of stocks. And it's exciting. We're going to hear a lot about their rules that they discovered. So I'm looking forward to it. Kathy, thanks so much for being here. Welcome to the show.
Yeah, thanks for having me. I'm excited too. We're going to be talking about something new. I haven't talked in other interviews about the sell rules, so should be really interesting. And this has definitely been the year of the IPO, as some people are saying. I mean, who would have thought it?
Absolutely. I mean, it's been a crazy year for Peloton, FSLY. We'll get into those big high-flying stocks. So perfect. Why don't we start with your background? So how did you get started with investing, and what were some kind of some key breakthroughs along the way?
You know, I was really lucky. My parents were value investors. My dad worked. My mom was a stay-at-home mom. But, you know, my dad invested. He learned from his father, and he kind of taught my mom, and they always encouraged me that, you know, it would be a good way to supplement my income and then also for, you know, retirement.
Mm-hmm.
So I thought, yeah, that makes sense to me. So I really started pursuing it kind of in high school and really more into college, and just tried different systems, you know, read many different books. I read Benjamin Graham's book,
Mm-hmm.
The Intelligent Investor, I believe, Philip Fisher's book, you know, Common Stocks with Uncommon Profits. But it really wasn't until I found Bill O'Neill's book, How to Make Money in Stocks, that it finally clicked.
Mm-hmm.
And I think, you know, we're both engineers by degree, and just the charting and, you know, looking for the accumulation distribution and looking for the charts, you know, very, very fact-based, I felt like, really appealed to me, just, you know, with that engineering background. So, and I think the pivotal thing that what really changed was I started making money.
Mm-hmm.
You know, I started following Bill's system. I'm like, oh, I'm making money. And I was able to join a IBD meetup right away and, you know, work with other investors and learn with them. And that community and learning from others, and then just having the book with the rules that made sense to me, that was really how it all happened.
Awesome. And as a part of your routine, what kind of software do you use, whether it's charting or looking up fundamentals? What do you kind of use day to day?
Well, you know, when I joined my first meetup, the IBD meetup, when I first picked up Bill O'Neill's book, I went all in on daily graphs. It was Daily Graphs Online back then,
Mm-hmm.
and Investors Business Daily, the digital version of the paper. And I've been using that ever since. Now it's MarketSmith, and really Investors Business Daily Digital and MarketSmith are my sole resources. I don't really go anywhere else. I've found it to be everything that I need.
Awesome. And I also understand that you're an endurance athlete. You compete in Ironmans. I thought that was very cool. Do you see any parallels between athletic sports, especially on the higher level, and trading?
Yeah, I definitely do see some parallels. I mean, especially with an Ironman, you know, long endurance event, you know, you really have to start training. I mean, for me, a year in advance. I mean, I always have worked out, and I've stayed fit, and I've done different things, but, you know, training for a 17-hour event, you know, definitely takes a lot of planning.
Absolutely.
And, you know, details, you know, a lot of details, making sure you have all the pieces, you know, your goggles, your swim cap, you know, your running shoes, your racing belt, and where are you going to fit all your hydration and all your snacks and all those kinds of things. And I really thought that was a great question, because even with investing, you have to do the same thing when you're reading the chart. You know, where's the relative strength line? Are all the moving averages going up? You know, is there accumulation in enough accumulation in this space that says this is the one that I want to buy?
Mm-hmm.
So all those details, all that planning, and that takes time. You know, investing is, I know, you know, it's like you need a 4-year degree for that as well. I mean, I started in 2004 or 5 with Bill's system,
Mm-hmm.
so now it's been 15 years or so, but, wasn't really making great gains until, maybe 4 or 5 years later, enough for another 4-year degree. So it's a lot of work. So I think, there's definitely some parallels there. And maybe that's another reason why that helps me. It has helped me become successful.
Very cool. So I really want to hear the story behind the book. So it'd be cool to hear kind of what was the genesis of the idea to make it and how you came across your other co-authors, and also your kind of personal reasons for doing the study and eventually writing this book.
Well, Eve Bobach, Eric Kroll, Kurt Dale, give them the shout out. My fellow co-authors, we met at my very first IBD meetup in Illinois.
Mm-hmm.
I had just moved there, and that's when I had picked up Bill's book. And, we became friends, and we, talked about stocks. It was the thing to do. And Eve one day was just like, it'd be really great if we could figure out how, what's the next Google? I mean, really, there's got to be a way, maybe it's the fundamentals, something in the chart, surely we can figure that out,
Mm-hmm.
and she suggested it to me, would you want to do it? I'm like, sure, why not? And really the reason I said that is any type of project, you learn something, like you were saying, you learn from everyone that you interview.
Mm-hmm.
And, training for the Ironman, I'm always learning something new about running or biking that I didn't know before. And that's how I got better at running or biking and swimming. And so I knew, working on a project on how to find the next best IPO, I would definitely become a better trader, because there's just
Mm-hmm.
so many things that we don't know, even though we think we know, we don't know. And then we forget, our brain can only hold so much. And then we have to remember the key components of what we learned when we first started out. So that was really the reason why I wanted to be a part of it. And then, of course, we were all very good friends. So Eric and Kurt wanted to be a part of it too. So we just kind of embarked on it. We had no intention of writing a book at all. It was just, can we figure this out? And, it was probably 3 or 4 years. It really dragged because we didn't set any deadlines.
Mm-hmm.
And we're like, we got to finish this. I can't believe we're still working on this. So finally, we set some deadlines, and we got it done. We got our research. We showed it to some other friends of ours, investor colleagues. And, they thought it was really great information. And we thought, well, do you think other people would find this helpful? I mean, we definitely thought it was helpful. And they did. And shout out to Eve, really, because she's always wanted to write a book. She didn't know what kind of book, but she always wanted to write one. And so when we were done, she's like, well, maybe we should write a book. And, Eve and I were such good friends. We call each other sisters. And she's like, well, will you write the book with me? Because the guys, they weren't necessarily completely on board with it. And I'm like, yeah, I'll write it with you. So that's kind of how it happened. I mean, obviously Eric and Kurt contributed. I mean, we couldn't have done it without Eric's programs and his statistics. So it was a great team effort. So that's how it happened.
Very cool. And just general thoughts about the study. How many different stocks did you guys look at, and what were kind of the biggest name IPOs that you really extensively studied to try to find those common characteristics?
Wow, you're gonna have to. I don't remember the exact number, but it was over 1,000 or so stocks. Wow. I didn't remember that. It's like 1,100 or 1,800. I can't remember the exact number, but it was over 1,000 stocks from 1982 to 2017, and it was all the ones that are still traded because. Mm-hmm. If it wasn't traded anymore, I mean, you probably know from MarketSmith, and that was our primary resource for a lot of this information. We weren't able to get that data if it wasn't traded anymore. But I mean, obviously Google, is like mm-hmm. everyone always says, what's the next Google, right? I mean, eBay, Facebook was a great one. I mean, it's our model for the pump and dump, and we'll talk about that later. So yeah, I mean, the way that I look at stocks now is so different than when I looked at them before, especially with the lens of the IPOs. And I was trading IPOs all this time, but now with this new lens, I think it just makes me more efficient.
Absolutely. Very cool. And when I first read about the study you guys did, it reminded me of the study that Bill did, obviously going back to the 1800s and looking at the biggest winning stocks, trying to find their characteristics. So I think this is a great almost extension upon that original study, and of course all the model book stocks that they put out.
Yeah, that's interesting. I agree with you, and that's really what it took. It was, and we in our I don't know if you know the story about the fish. Bill used to always say, well, how do you learn about fish? You got to watch the fish. And so we were just like watching the IPOs, it's like, well, let's just look at a bunch of them. And that's how we were able to, well, look at this pattern, and this is like that pattern. And so that's how we came up with the different patterns, the late bloomer, the pump and dump, etc.
Super cool. So you prepared an excellent presentation talking about the phases and those patterns that you just mentioned, as well as the rules. So why don't you go ahead and bring that up? Sure. And we'll get going.
All right. So just the quick disclaimer, I don't need to read this. Everybody knows. And at the end of the day, I'm still learning, just as we all are. And that's how we become better, is to just be open and learn from others. So yeah, we looked at all these IPOs, and we wanted to also see if we could come up with rules, the best way to trade them. I mean, we all had our different styles, and I think that's also what helped make the book better, because I was more of a long-term holder. Eve's really good at, fast movers. Eric's probably a little bit of both. So we came up with these different rules, and these weren't the original rules. We actually had some different versions of these. We tested them, and then we tried to optimize them, and ultimately these were the ones that we went with. And you'll see I have 3 different categories here. I've got the short-term rules, the midterm, and the long-term, because again, as I was telling you, we're all different kinds of traders. And, we wanted to kind of have a balance that also could help, our readers figure out, well, we didn't know back then, but now help our readers, because not everyone can stand through a drawdown. Some people, it's okay. So we've got the Everest rule, and really that's the rule you want to use for those parabolic moves, those really, really fast movers. And basically the way it works is, the low of the 2 days before is your stop. And then if it gaps up, you can let it come below that gap, and then that will set where you sell it. So really, really, really fast. The ascender, and that rule can also be used in the long term. And this is there, you'll see it on the other column in the green section. Because what if it's the end of the run and it's going into a climax top, right? You could use the rule for a climax top situation, which is what Bill defined in his book, How to Make Money in Stocks. Also in the short term, we've got the ascender rule. And this is kind of like a combination rule where you can take profits on the way up. So, you're locking in some gains, but then at the end, you're still being able to participate if it's one of those long-term movers. So we'll look at some stocks today, and I'll show you where we would have sold like half the position. That's the first trigger. And then selling at a quarter, and then selling the last bit at a quarter. And basically we're using the moving average lines for that. The 21 exponential moving average first, then the 50-day, and then finally it'll be, well, if it undercuts the original purchase price, obviously you're going to sell that last piece. But again, it's just that quarter that remains. Or 18 months. And 18 months is, and I'm sure you've heard this, most big super growth stocks, their first big run, because they can have other runs, you never know. Usually a year and a half. So we used 18 months. And then, or 500%, whichever comes first. So we'll look at that. And then the midterm rules are really for capturing those big gains. And then if it has the first deep correction to that 10-week line or breaking that 10-week line, we're kind of cutting it. So the first part of it is 2 closes under the 10-week simple moving averages. You use those as your low. And then if it goes below that even more, about 6%, then you're getting out. But it also has another trigger. If you've already been holding it for a year and it's the first close below that 10-week, then get out. And that's, that year to 18-month kind of thought process there. And then the other part is there are some triggers though. What if it's just 30% off the peak? Well, let's just take those gains and it doesn't even matter if it broke the 10-week line. 30% off the peak, I want to lock in those gains. And then lastly, also if there's a break below the 40-week, because maybe it's at a point where the lines have caught up to each other, that kind of, and it's not off the peak, but you're breaking the 40-week line. And the 40-week line in some cases can mean the run is done. And I do want to shout out to Ajay, Jani, because I'm sure you've seen him on Twitter. This rule was really inspired by him, and it was a rule that a lot of us used. And so we really wanted to include it in the book with his permission.
Very cool.
And then the long term is the Everest rule, as I mentioned, where you could use maybe at the end of a run in a climax top situation, which I already mentioned. Or you just wait until it breaks the 40-week line, 1% below, that rule right there. And that rule is really inspired by me because I've always been a long-term holder. My parents, I mentioned earlier, were value investors. And I think I have, even though I like growth stocks, and I went to the growth stock model because I wanted to retire early from my corporate life and be my own boss, as I mentioned to you. But yet I have this, I think, value gene from my parents that I can at least hold things for a little while and not have to do a lot of investing because, value investors will hold for a long time and you get the dividends and all that kind of stuff. Of course, I'm not necessarily looking for stocks with dividends, but anyway, long story short, the 40-week line, you close 1% or more below it, then you're cutting the stock. So that's a quick overview of the rules. Any questions or does that make sense? Did I miss anything?
No, I think that was a great explanation. And personally, I'm definitely more on the short-term side, I think. My own rule set is actually very similar to the sender rules, which is very interesting. I use a kind of 1% below the 20-day EMA as one of my sell rules. Could you briefly explain, because you didn't quite mention the IPO Advance Phase, the Institutional Advance Phase, and those two differences and kind of how you separate between kind of more short-term and longer term.
Yes, thank you for pointing that out. I missed that part. So yeah, I broke up the rules in the short-term, mid-term, long-term. And so speaking of it from the IPO phases that we identified in the research was the IPO Advance Phase, which is usually the first phase of the stock. If the IPO goes up from day 1 to, I don't know, day 90 or more, who knows, we call that the IPO Advance Phase. And so, yeah, that's where you would want to use that Everest rule or that Ascender rule for sure. And you'd want to lock in shorter term gains. You can also apply the midterm rule in those phases, but you have to know that that's going to be more difficult because usually by the time it hits the 10-week line, it's done, and then you're going to end up round tripping all those gains. So that's why the midterm rule is better for the institutional advance phase. And I like to also call it institutional accumulation phase because that's when the institutions have decided that the stock is good after the due diligence phase, which I'll show in the chart in a little bit. And that's where I feel like is your most, your greatest odds of really getting the most gains out of that stock early, right? So yeah, the midterm rule is good for that institutional advance phase. And then also the 40-week line is also good for the institutional advance phase because again, I feel like once you get out of that due diligence phase, the institutions have made up their mind, this is a stock I want to be in for a while. So that's going to be your most rewarding part of the stock to trade. And the midterm rule and the long-term, the midterm rule and the 40-week rule will help you capture a bulk of those gains However, with could potentially larger drawdowns versus the ascender because you're taking gains on the way up.
Absolutely. And just immediately when I look at these rules, I'm thinking this year, maybe PLTR would have been good for the Everest rule right after it broke out of its IPO base.
Right.
Corsair, Unity maybe. And then more on the longer term, the 40-week rule, you've got some long-term winners like Shopify and TWLO, which I think I've read or heard in an interview that you are a big fan of TWLO and have traded extensively. So yeah, those seem to match up well with these different rule sets.
Yeah, TWLO I've discussed before. I was able to buy it right after the institutional due diligence phase, and I used the 40-week rule to play that institutional advance phase.
Perfect.
So yeah, definitely. Yeah, if we have time, we'll definitely have to look at PLTR and Corsair, because those were definitely some interesting initial runs for sure. All right, well, let's go to the first stock. So Crowdstrike, everybody is familiar with Crowdstrike, I think, or your viewers, I'm sure, for sure would be following this stock. So this is MarketSmith. I mentioned that they're the service that I use, so definitely want to give them a shout out. This is a weekly chart, and you'll see, obviously, the IPO was started here in June. There's the beginning of the phase. So I've drawn a blue arrow here, and that's just to signify that initial IPO advance phase that we were talking about. So Crowdstrike created this initial IPO base, also identified by MarketSmith, and had a little bit of a run. And it looks like it was about 21% or so for IBD, can slimmers. They know this green flag is the 8-week hold rule. But like as we know from our research, this was IPO advance phase is short-lived. I mean, if you were holding it for 8 weeks or more, clearly you were done after that. And this box right here kind of signifies that institutional due diligence phase. And basically, this is the time where institutions are researching if this is a stock they want to invest in, as I mentioned earlier, for the long haul. And, this could also be when the initial investors that invested in it or, got their little bit of a profit and they're out. And it may or may not come back, right? We don't never know for sure. A lot of IPOs, as you know, don't have earnings yet and maybe only have sales. Mm-hmm. Or they might not even have sales yet. So when you think about it from a fundamental category, like, is this a stock I really want to invest in? Value investors, I think probably, they're not looking for that kind of stuff. So you have to, and even, can slimmers, Bill O'Neill, you got to have earnings. And in some cases, we don't have earnings here. So how do we trade it differently because of that? So that's why we like, and what we've noticed is that all these IPOs, there are exceptions, will go through this due diligence phase, and most 90% or more will undercut this day one low or even the weekly close. I mean, this is a weekly chart, so we can't see the exact, but it's clear that it got undercut. So there's really no need to be in a hurry. But if you have shorter term rules like yourself, then yeah, clearly you probably could have traded this very easily, got out, and then you were done. But someone like me, I got to pay attention to it a little bit more. I may not want to do that. So I'm just going to wait for this institutional due diligence phase to be complete.
Very cool.
So, go ahead.
Yeah, I just had a quick question. We're starting off on a weekly chart. I'm sure as a more longer term focus, are you mostly looking at the weekly chart even during the week, or do you also trade off the dailies?
So daily charts are very important for finding, very specific buy and sell points. But I think I channel Bill O'Neill, and I guess I'm going to be talking about him the whole interview because, I really learned from him everything that I know. But yeah, he liked weekly charts, and I do too. And it's just still ingrained with me. I like to see how the whole run looks. And you can't always see that in a daily chart because, it's longer and it looks more volatile. And during the week, to answer your question about, well, do I look at it all the time? Well, definitely, because on a day that's down and a lot of stocks are negative, and there's all this doom and gloom from like one bad day or maybe even 2 bad days, I'm looking at the weekly chart and the positions of the stocks that I own, and I'm like, well, it hasn't even touched the 10-week line, and it's on light volume. So I don't get super excited just because I see a down day. I get excited, actually say, okay, well, maybe this is the start of a little buy add-on point. You know, maybe I'm going to get a little bit of a consolidation here, and then I can be ready to buy it, 4 or 5 days later. So yes, I use weekly charts on a daily basis, and in addition to daily charts.
Awesome.
So, and then I just drew this last arrow here to signify the institutional advance phase. And as Crowdstrike's still doing well. These were, I guess I screenshotted these a couple days ago. So it's not completely accurate for today. And then this is a late bloomer. So we call it a late bloomer because it had an initial run, and then it had its due diligence phase, again signified by this box, and then it had its new run. And what I think is important to highlight here is the turbulence zone. So this top line of the box right here is really where that turbulence zone is. And that's just the prior high from when it first had its run after its IPO. And you'll see it had some turbulence right in here at that prior high, because maybe there's people still holding it or just the psychological factors. It made a base. And that's, you could call this that first mature base. We talk about that in the book, a first mature base. And mature because, okay, it's already been, over a year, it looks like at this point, and it made a nice little consolidation, and it was ready to go. The institutions made up their mind. Now, I know there's plenty of people out there probably drawing early trend lines and getting down in here. That's totally fine. I have no problem with that. And in fact, I'm probably doing that for sure. But, this is the base you're looking for, or if you want to try it early, because it looks like it's coming back. I mean, clearly a lot of stocks had this pattern because of the pandemic. So if you were on it, you were getting even more additional gains here.
Absolutely. I was actually going to ask you whether you buy within the due diligence phase, but you beat me to it.
Yes, I absolutely do.
Absolutely.
And sometimes it doesn't work. You mentioned Twilio. We just talked about Twilio. I had to try that twice in the institutional due diligence phase. And I think the second time worked, but the first time didn't. I got shaken out and I had to try it again.
Yeah. One more question I had was, is there like a set length that the due diligence phase lasts, or because a stock like NEO actually had a very, very long due diligence phase compared to something like CrowdStrike, which was just a few months really?
Yeah, we didn't set or define the length of the institutional due diligence phase. But what I have observed is that right about where the 40-week line starts, that's a good time to start looking to see if it's going to transition. And I feel like that's pretty consistent. I mean, obviously there's always going to be outliers. And then I've also noticed stocks with really, really long institutional due diligence phases. I mean, I think Snap is a great example. I think CyberArk was one. And I think they can also be successful, but I also feel like, well, they're even more mature. I don't want to say old, but more mature than CrowdStrike, and may just have a more difficult time. Again, what I've observed. We didn't go all that far out, but I feel like the really big gains are going to be the ones that have had the shorter due diligence phase, but doesn't mean it can't reinvent itself and then get going. I mean, I'm surprised at how Snap has turned around, and now it's a leader. So.
Mm-hmm. Yeah, well, it's interesting because I guess the social media stocks are kind of more in vogue now. I mean, you've got Pinterest, which had a shorter due diligence phase, but maybe Snap is kind of riding on its coattails a little bit. Yeah,
exactly. Yeah, so that'll be interesting. So we'll keep our eye on CrowdStrike. So here's the daily chart, and I've color-coded the arrows. So black is buy, the Everest sell is red, the Ascender is blue, and the Midterm is green. But in this case, Crowdstrike hasn't had a 30% off the top when it started correcting below its 10-week line. Actually, let me see if I can move this picture box of us so I can see the chart. So, you know, I just want to point out here where it corrected to the space here. You know, it did go below the 10-week line. So the midterm rule is looking at this, and you'll see, I can't really tell if it had closes below, but we're using the lows of these breaks of the 10-week line, and it never went 6% below any of those. So that wouldn't have triggered it. And then this base is not more than 30%. It never went more than 30% off the peak. So that rule did not trigger. So when we look on the daily chart, you won't see any lines for midterm sell so far on this stock. So here I show the buy point. Actually, I show it right above the 40-week line. So I was telling you, you know, 40-week line's a good spot. So that's where I decided to show. I mean, we could have shown it at this base. But if I'm going to be true to myself and to the audience, you know, this is where I'm looking to buy. So that's where I chose the buy point. So within the institutional due diligence phase, as you mentioned. And now the Everest rule, because it's looking back 2 days for the lows, right here, I mean, it was already going out because it was very choppy in here. So we don't need to focus on that too deep. But now we've got the ascender rule, taking profits on the way up. This was the first base. And, you know, since we're not using MarketSmith, I can't pull up the exact number here, but you see where it's breaking and closing below the 21 EMA more than 3%. So that's where we're taking the first half. We're taking all the profits from here to here for the half. And I've got the numbers in the next slide. And then in this case, it triggered right away. Then it broke the 50-day. And again, 3% below. So now we're taking off a quarter. And so now all we have left in Crowdstrike is the last quarter. So if we look at the numbers, and let's just jump to Ascender here, the third row here, Ascender 1. So that's part 1 of the rule. So sold on July 24th, and you got 48% on that first half. So respectable gain there. And then the second part of this Ascender, 53%. So a little bit more. But now you've got that last piece, which that last piece is worth 205%. But overall, again, as of 12/29, you've got 89% on the total trade if you were just using Ascender. So respectable, right?
Not too bad.
Yeah, not too bad. I think most people would be happy with that. And I show here how, you know, that first half's closed, quarter closed, and got that last part open. And then the Everest we saw wasn't really much, 4%. So, but the big gains right now is that 40-week, right? And then the midterm. So we'll see what happens. We'll have to do a recap, I guess, and follow up what happened between now and the next time. So I don't know. Hopefully it'll be, well, let's see. It hasn't been a year yet. So 18 months, you know, or 500% if we're looking for the midterm rule. So to be determined.
Absolutely. And is that 18 months from the start of the the institutional advance phase, or is it from the IPO price?
The 18 months is actually from when you purchased it.
Gotcha.
Yeah. So, but you can definitely, I look at that on the charts. I don't know if you do that too. And IBD does a really good job. MarketSmith, I'll point it out in the next slide, of showing where that 18-month line is. So you could definitely take that into account. But the rule is 18 months from the day you bought it.
Perfect.
Okay, so here I'm just highlighting the two that are the best so far, and that makes the most sense. But the 40-week, you know, could potentially have the biggest drawdown, because the midterm will get you out in a 30% from the top, but the 40-week may not, because, you know, the 40-week line can be, you know, 50 to 70% higher. So those are things that have to be taken into account.
Absolutely. And myself, as a more short-term trader, I might trade around that last quarter position, adding on future base breakouts or other entry points.
Yeah, right. This doesn't take into account any of that, right? You just want some straight rules, which is why I think it's good for people that are new getting started, I'm actually mentoring a friend of mine's son who's, I guess he's in high school now. Yeah. And, he's trying to come up with his rules. And I'm like, well, here's you can use the 10-week rule we came up with, the midterm rule, and, come up with, or a version of that, but at least something to get you started. So.
Absolutely.
Yeah. All right, so this is FSLY. This has been a wild one. This is one I traded. I don't own it anymore. But similar to CrowdStrike, it did have an initial run up with this, looks like a crazy double bottom, volatile double bottom here as a first base. But we'll count it. And then after that, and again, oh, interesting. We pointed out the 8-week hold rule on CrowdStrike, and FSLY had it as well, and then immediately proceeded to tank after that and created this kind of short, also due diligence phase. And here again is the turbulence zone right at the top, and it's already powering through. I believe it was an earnings that started this move and then kept going up from there. And so then now we're in the institutional advance phase. Okay, and this is, so again, a late bloomer.
Mm-hmm.
So before we go to the next slide, so we can see already from here, it hasn't touched the 40-week line. So the 40-week line is still in play as long as, you were following your rules and mentally could withstand the craziness that happened in this chart here, right? But you'll see this right here is a 30% drop. So the midterm rule is going to take us out. So we'll look at that in just a sec here. All right, so here we are on the daily, and I used that gap up on earnings as the buy point. And even if you didn't buy the gap up, you could have bought it the next day because it was already going higher than that gap up day. So I think that was a good place to pick, and it, right at near that turbulent zone. So Everest, you made a little bit more, but then when it pulled back here to the 10-day, you were out. You were 2 days past, and so you were out. But the ascender got you all the way up, and the bulk of these gains. It didn't break the 21 EMA more than 3% until this day right here. And then because it was so volatile, it wasn't that long until later when it took out the 50-day here, 3% or more. And then here's the green midterm arrow that I was talking about previously. And this is actually, I put the arrows next to each other, but it was actually literally the same day that the ascender took its first half out, the midterm took all of it out. And then the 40-week is still open. So the 40 weeks is still open. You've got 154%, but the midterm got you 134. So that's great, right? Mm-hmm. And that was simply just 30% off the top, the kind of circuit breaker part of the rule. And the ascender, the first part got you 125, and then the second part 132, because it was just a little bit higher. And so overall on this situation, because it never broke that 21 EMA till way, way up, you've got a good cushion there. You're at 134% as of 12/29, but just that last piece open.
Mm-hmm. And I'm curious about the 30%. Is that something that you guys looked at the depth of bases after that first pullback, or is that something more from Bill's book or previous studies?
That's a great question. Again, it was inspired by Ajay, Jani, and it was his rule. So we would have to ask him specifically where he kind of came up with that. But I think it would make sense. I mean, I've heard some people have these kind of circuit breaker type rules, and so I guess he just also came up with that as well. But I don't want to speak for him, so I don't know. I'm not for sure.
We'll ask him on Twitter.
Yeah, maybe
he'll give a response.
There you go. We'll ask him. But I mean, it makes sense, if you don't want to withstand big drawdowns, a good base is, 30% or less, really. I mean, it would keep you into flat bases. And I'm speaking Bill O'Neill definitions of flat bases, and cup with handles, usually you want it to be, 30% or less. So from that perspective, I think it makes sense.
Mm-hmm.
But yeah, great question. All right, I did not play fiber at all. And boy, do I wish I did, right? I mean, this kind of came out and I don't know, I just missed it.
And it didn't give you that much opportunities to get in on a pullback either.
Yeah, it really didn't. But yeah, this is a great one. So here's an example of our pump and dump. So a pump and dump doesn't have an initial IPO advance phase. And I think in the book, we just called it an advance failure because it didn't advance, it just went down. So it just really went straight down and went right into that due diligence phase. And so I'm boxing it right here. And I'm obviously want to show the turbulence zone. So that's why I bring the box up to this height right here. But IBD or MarketSmith created this, found this first mature base right here within the due diligence phase. And, you know, I got to say, I'm glad you brought the stock up because this is really interesting because you see this due diligence phase and it's pretty tight. And then this first base is volatile. Mm-hmm. Usually you see the character change from, you know, volatile to tight, not from tight to volatile.
Yeah.
So interesting. And maybe I did see that and I was like, oh, that looks too volatile. Maybe that's why I didn't buy it. I don't remember. But yeah, I had a really great run, still in its institutional advance phase, and pump and dump as I pointed out. So you can see we have no break. We have this one break of the 10-week line, but did not close below it. We have no 30% off from the top. So we're doing good on the rules on this one. So we'll look at that in just a sec. So here's the daily, the Everest, obviously you are out on. Here's the first break of the 21 EMA. So you do get part out on the sender there. And then you do get the other part because it did break it here and it actually closed, even though the week was above because it closed below that line. So we had to take it. So in this situation, you've got 464%, wow, on the 40-week and the midterm. The ascender, right now you're doing great still though, 291, but it's still open that last piece. So you just got to get the right stocks and
buy them at the right time.
Yeah, buy them at the right time, right? Wow.
This one is almost hitting the 500% gain.
Yeah, almost.
Yeah.
Almost. We'll have to, if it does, then yeah, the ascender will be out. Only 36% more to go. Yep. We'll have to keep our eye on that. Is this one that you traded?
Yeah, I've traded this a couple times this year, and I actually got I got stopped out during those two volatile weeks when everything was pulling back when the Pfizer vaccine, I think that news came out on that Monday. So I got stopped out of it back there. I haven't gotten some great gains on this one, but it's definitely been one of the biggest winners this year for sure.
Awesome. Well, good job.
Yeah.
All right. Well, we got to talk about Peloton, right?
Absolutely.
This has been an interesting one. Another famous late bloomer, initial run up in this really volatile double bottom, and really kind of created a really great buy point when it kind of shot back up to the turbulence zone right here and then pulled back and then broke through. Believe that was on earnings as well. So you could have bought it, you know, there. I mean, or maybe this first pullback, you know, this one wasn't as concrete as some of the other ones, right? But it's just had a great run since then. And I don't believe this was 30% off the top either. So I think we're still in it from that midterm perspective. And we've had a little bit of the break of the 10-week, but not enough to get completely out. Mm-hmm. So let's just look at it more closely. So again, Everest, you want to use that on fast rules or fast moves. So here you didn't have your first break of the 21 EMA till that base that we were looking at on the weekly chart. But like the other ones, you soon thereafter, you were taking the rest of it. And in this case, this was actually less because it went down even more versus what we saw earlier. So I'll just go right into it. I mean, we're still in on the 40-week in the midterm. And then you can see here, the first part of the ascender, you got 189%. So That's fantastic. And then you've got the second part was, which the 10-week was a little bit lower, 163, and overall you're at 209. So
not too bad again.
Yeah, not too bad, right? I mean, we need more year of the IPOs.
Yep, absolutely.
Okay, well, here's Zoom. And, Zoom is struggling. This screenshot was taken, like I said, a couple of days ago. And now, unfortunately, I think it's a little bit lower. So, but you got an initial run up here. There's that really big base. It's kind of cool that the institutional due diligence phase is actually encompassed in this entire base. So you had a very clear buy point. And, this one was so interesting, right? Because we had the pandemic and it was just so volatile in here. And I had a friend that called it a heart attack stock. But truth be told, I've shared on other interviews that I own this one, and I still own it even now. So, because I'm a 40 weeker, so I'm gonna be. We're not supposed to hope, but I guess hoping it holds the 40-week line. We'll see what happens. But it's had a really great run, as you know. This is also a late bloomer. I feel like those are probably late bloomers, and pump and dumps are probably the most common. So here it is. So in this case, because it was so volatile, that first part of the ascender rule was getting you out really early. I mean, I struggled because I had to zoom in and I couldn't still get it all, but this is where it first broke the 21 EMA, that 3% below. And then when you had that first kind of pullback pseudo base, that's where it broke the 21. So in this case, unlike the other ones, we're taking those gains right away. But we're still holding the last piece, just like on the other ones. And then with the midterm, you were 30% off the top. Let's just look at that really quick. I mean, right in here. I mean, that clearly you're way off there. Okay. So the midterm, you're out, but 276%. The 40-week, you're still in at 230, less now today, as of today. I don't know exactly what it is. And so here we have a different situation. The ascender, you took your first profits only at 14%, but the second part you got a little bit more, 115, overall 93%. So, and then of course Everest, so volatile, you only got 2% on that one. So,
would you be able to go back to the weekly chart, because I think there's a good point here. In contrast to Fiverr, this was very tight on the right side, coming back up through the due diligence phase. So there's actually a couple buy points there as it was coming up, and there was a nice breakout beforehand. So maybe if you had gotten in a little bit early, you could have withstood all that nastiness right near the turbulence zone.
Well, Richard, since you brought that up, I will have to tell you that, yes, that is where I was buying it. I was buying it within the due diligence phase in here. And so when people ask me, how did you hold on to it through here? Well, I had it a little bit early and it never broke the 10-week line. So I said to myself, well, I can do it. My rule definitely doesn't have me getting out when it breaks if it doesn't break the 10-week line, even though, yeah, those are volatile. And I think at that point, with the pandemic, I had cleared out most of my stock holdings, and it was really only this one and maybe one other one that I was holding. So from that perspective, my risk management had already been greatly reduced, and I was just really trying to hold on to that one stock, and I think one other one at that point.
During big corrections like that, do you still follow your 40-week rule and just do it on a stock-by-stock basis, whether you get out, or during a dramatic correction like that, when you see all that distribution piling up, do you either reduce or get out?
Are you talking about in this part of the stock?
I'm asking during the February March crash, how did you handle your stocks overall?
Oh, right. That's a great question. Well, I didn't uphold to the 40-week rule on all my stocks during that time. You know, it's almost like this is a really exceptional period where we're having this dramatic turn down, and there's no reason for me to take on all this risk and still wait out the 40-week line. In general, I want to let my stocks decide and not let the general market decide. But when you've got the NASDAQ going down 35%, I was just like, no, I can't do that to myself, right? I mean, I was already taking gains off of, gains off the top of all my stocks. And it was just a good time to really, for me, clear the decks and kind of start fresh and kind of reorganize, because I had already had some other stocks for a long period of time. And, at this point, my position sizes have changed, and it was just a really good time to get organized. So I kind of I used that pandemic as an opportunity to do that when the market corrected.
That's very interesting. So do you let your positions and the weights within your portfolio grow naturally as those positions increase, or do you from time to time do kind of restructure maybe during a correction like you just did here?
Yeah, I mean, this is the first really bad bull market. Well, I guess I shouldn't say that. I mean, 2008 was bad, and I was trading back then, but I was still so new at it. So yeah, I mean, that's a great question. This is really the first time that I've ever done that and kind of cleared the decks like that. And things have, with my transitioning from work into full-time investor, really only 2-3 years ago, whenever it was, I had all these different accounts and I had pieces of this and pieces of that. And so it just made sense. It just made sense to do that. But I don't go back to your position question. I don't go back in time and up positions to new position sizes of stocks I already own. Mm-hmm. So that's why it also kind of made sense to just take those gains and then just like start over. Mm-hmm. So that way everything is kind of moving at the same rate at some point and not just lagging so far behind, because I do like to hold for so long if it's a good stock.
Awesome. Cool to know.
Yeah. Question. Okay. So the last one I prepared was Livongo, and this one, got bought out by Teladoc, so we can't trade it anymore.
Unfortunate buy there.
What's that?
I was going to say it was very unfortunate that it got bought out, because this might have gone on and outperformed even more than it did this year.
Yeah, I mean, it really was such an amazing stock. And, because like I was saying, I don't know exactly what day, but, at the time that this snapshot was taken, I mean, we're almost still all the rules, because there was, it would have been so interesting to see. I mean, this was like a monster stock, right? Mm-hmm. It just looks so perfect, even when it started correcting. But it was a pump and dump. So it went down first and created that due diligence phase. And here's the start of that 40-week line. So again, right. And as it so happens, that's when it's kind of starting to come out of it. So that's why I was saying I observe that's a good spot to start looking. And then, was kind of breaking out even before the turbulence zone. But then you also had an opportunity here to play this run right here. Pump and dump. So let's look at it on the daily. So I'm showing the buy point, kind of right at that previous, that turbulence zone I was talking about. And that also coincided with earnings, which happens a lot, right? We know that. The Everest rule taking you out pretty soon as it was correcting. Oops. And you show we have a tail here, and it looks like, well, maybe the ascender is getting you out the first part of the 21, but it closed above it. So you're not out of it. You're still in it right there. And then you don't ever correct more than 3%, even right here. And so you're still in it. So, wow. I can't say what they were, but the only one that had triggered was just that first part. Oh, I missed the arrow. Maybe there was one in there. I show the half closed, but the other ones had not. So we'll never know what the real result would have been with Livongo.
Yep.
But the Everest actually was the best of the ones that we've looked at. Everest actually had the best return of 48%. So because it went up so fast there in the beginning.
Thinking back to 2019, would INMD's run have been a good time to use the Everest rule?
Yeah, I think so. I didn't play that or the Everest rule, but yeah, definitely. Or even TLRY would have been really good. And all these dates, let me just point out, all these dates and prices are approximations because they were screenshot charts that I had. So I wasn't able to actually track the price on that. So, but yeah, I mean, so, I'm really glad that we did this because, I was happy to see, okay, the Lifecycle Trade rules, definitely would have kept you in many of the super growth stocks with big gains. So, if people are out there and don't know what rules to use, or maybe they weren't as successful, these are things they can look to and maybe it'll help out. The Ascender rule, you're able to take some profits on the way up, but while still participating in the big move, and I think mentally that's always a good thing. Like, oh yeah, I had it, but I sold it really early. Well, with the Ascender, you can still, well, yeah, I still have it, I still have some in it. I think that can do good for our mental capital preservation. And then the midterm rule protected us from those 30% drawdowns from the top in Zoom and Fastly. And then obviously, I just want to point out, the Everest rule obviously works best for parabolic moves during the IPO Advance Phase. So we'll have to look at that more in detail another time, probably.
Yep. Awesome. And I love how I think anybody who's watching this can take something away because of these different, the different type of traders might gravitate more to the Ascender rule versus the long-term rule. You've got the Iron Man, heart of steel. You can sit through those drawdowns. While I'm a little bit more skittish and like to get out before it really pulls back to the 50 SMA. So I think that's great. To wrap up the video, I just have a few more kind of final questions.
Yeah, let's do it.
Yeah. Did you have anything more you want to talk about in your presentation?
No, that was all I had for today anyway.
Yeah, perfect. So I guess my first question is, do you have any advice for traders or investors who want to do their own study similar to what you guys did?
Oh yeah, definitely. I think ultimately you have to set deadlines. Because and you have to agree on the scope, right? Because scope creep and not having a deadline is a problem. Because you would look at stuff, right, and you'd be like, well, what about this scenario? And it's like, oh man, I don't know if we can look at that too, right? So it's like, okay, well, you got to think about, well, is it to the core of the initial mission of the project? And if it fits, okay, well, we got to include it. But if it doesn't fit, it's kind of an outlier, like, okay, well, that'll be round 2 or phase 2. So yeah, definitely scope creep, and then something to get you to finish. And actually, it's funny, when we finally set a deadline, it was probably like, it was the year before. I don't remember what part of the year, but toward the end of the year, I'm like, well, let's say May. We'll graduate in May. So that was kind of like our deadline. Is we got to do it by May and we'll graduate. So kind of funny.
Awesome. And one thing I thought would be great to ask you, since you're actually the first woman I've interviewed on the show, I've noticed a lot of my analytics say most of my audience is entirely men, and also on Twitter I've noticed most traders are men. So I wanted to ask if you had any kind of ideas to maybe encourage more women and girls to get involved with the stock market, which can be so beneficial to anybody who does get involved.
Yeah, absolutely. Well, I definitely want to say to any women that are listening to this, even if you're not a trader or investor, the research I've seen says that women investors are actually statistically a little bit better than male investors. So at the very least, know that you've got that advantage and maybe that will help encourage them. But, I think it's all of our responsibilities as investors, male and females, to be educating our young people, again, male and female, to look into becoming investors and managing their money. I've often thought about maybe creating a group of just women, but I want to make sure it's still open. I'd want to include men too. But yeah, I don't know what the answer is, but I do feel passionately about, if there's a way to bring it into the schools better at a younger age, like in high school or even grade school. And just, but just talking to all of our friends' kids and just getting them involved. I mean, that's how this is the first, I told you earlier, I'm mentoring my friend's kid and he's in high school, and it's like, that's whenever he asks me a question, it's like my number one thing is to answer his question and to keep him motivated and get him to have rules. But yeah, I think it's just like engineering, they have programs now, I think, for, math and science to help girls get more involved in engineering. And maybe that's what we need, something like that also for investing.
Absolutely. And I think, like you said, the earlier you can do it, the better, I think, just so you get people thinking about this type of thing and financial literacy in general.
Yeah, absolutely.
Great answer. So I guess my last question is just, do you have any motivating words for anybody completely new to this, outside of buying your book, which I recommend to anybody watching? Go ahead and check it out. But yeah, do you have anything that you'd like to say to people maybe who their performance wasn't as great as they'd hoped this year? And yeah, do you have any advice for new investors, basically?
Absolutely. Well, to follow on with the Ironman theme, anything is possible, right? And so you just got to keep working at it, right? If you enjoy it and you have the aptitude to it, you can do it. And you just got to keep at it. And that's one of the things that Bill O'Neill wrote when he signed one of my books a long time ago. Keep at it and just persevere, because you'll get there. And you have to, my number one success, I think, is reviewing my post-analysis and studying what I did wrong first. What was the first thing I did wrong, and fixing that problem? Because usually if you can fix the first problem, then all the other things you did wrong will go away because there just aren't really problems. You're trying to fix a problem. So, what was that root cause? So really taking pictures, snapshots of your trades and really studying what you did wrong or right and what you could have done better and tweaking your rules, and you'll get there. Mm-hmm. You'll get there.
Awesome. And I think for me, buying right is the thing I'm most trying to fix in 2021, because I think we saw in these charts, if you bought that first earnings breakout, you were able to sit through a lot of this noise following these very simple rules, and it just makes things a lot easier in the long term.
Richard, you might even turn into a long-term trader and you don't even know it because you got that first buy point.
Yeah, you're right. At least with the core position, maybe a half position with that initial buy. Yeah, absolutely. Awesome. So Kathy, thanks so much. It's been a pleasure. I've definitely learned a lot. For anybody watching, thank you guys so much.
Thanks, everybody.
Thanks so much. Leave a like down on the video if you enjoyed it, and feel free to reach out to Kathy and the other Lifecycle Trade crew on Twitter. I'll have their links below in the description as well. And I'll see you guys in future videos.
Happy New Year.